Okay, the solution to the first of the Module 7 additional problems. In all of these additional problems, we assume that big company owns 60% of little company and that each year little reports $100,000 of income. For each of the following intercompany transactions, prepare appropriate elimination entries arising from the intercompany transactions, that is, just the entry or entries related to the intercompany transaction, and compute the income to the non-controlling interest. So basically we're going to skip the S, the A, the I, the D, all that stuff. All we want are the entries specifically and directly arising from this intercompany transaction. Okay, so for the first of these, we have on January 1st, 18, little company sells land to big for $50,000. It originally cost $40,000. A couple years later, I'm sorry, I dropped my mouse. A couple years later, on 3/1/20, the land was sold to a third party for $55,000. And we're going to assume that big uses the full equity method. So first, in 2018, the year of sale, little company has a $10,000 gain on their income statement. We need to eliminate that gain because you can't have a gain from selling an asset to yourself. On the credit side, that land is now sitting on Big's balance sheet at $50,000. The true cost is only $40,000. So we have to go ahead and reduce that by $10,000. The income to the non-controlling interest, again, they're going to get their share, 40%, of the reported earnings plus or minus any adjustments. Now again, the key issue here is this was an upstream transaction. Little sold the land to Big. That means that that unrealized gain is sitting on Little's income statement, which means that their reported earnings of $100,000 are overstated by that. So we need to go ahead and subtract out that $10,000, so the non-controlling shareholders get 40% of the adjusted or realized earnings, so 40% of $90,000 is $36,000. In 2019, we need to do our elimination entry again, and the easy part is that that land is still sitting on Big's balance sheet at the inflated $50,000 value. So again, we're going to have to reduce it by $10,000. On the debit side, we're carrying forward a $10,000 unrealized gain. And again, we have two questions we have to ask. First, was this an upstream or a downstream transaction? This was an upstream transaction, which means the non-controlling interest is going to be involved in this. So we're going to go ahead and allocate of that $10,000 unrealized gain, we're going to allocate 40% of that to the non-controlling interest. For the parent's share, we have to ask, are we using the full equity method or the modified equity method or the cost method? And again, under the full equity method, which we're assuming here, Big company, when they reported their investment income in 2018, they would have corrected their investment income to remove that unrealized gain. So their investment income in 2018 was fine, which means their retained earnings is fine. Instead, we're going to allocate that to their investment in Little account. If this had been the partial equity method, where that adjustment wasn't made in 2018 to Big's investment income, or the cost method, where clearly they wouldn't have done anything with this intercompany sale, then we'd have to adjust retained earnings. Income to the non-controlling interest, again, they're going to get their share, 40%, of the subsidiary's reported earnings plus or minus any income adjustments. Now looking at that elimination entry, there are no income statement accounts there, so they're simply going to get their share, 40% of $100,000. In 2020, the land is sold to a third party. Now we still have to carry forward the unrealized gain just as we did last time, but on the credit side, that land is no longer on Big's balance sheet. They sold it to somebody else. And, you know, we have some actual concrete numbers to attach to this. Big sold it for $55,000, so Big is reporting a gain of $5,000. They bought it from Little for $50, they're selling it for $55. From a consolidated standpoint, the true gain is $15,000. The true cost was $40, and it was sold to an external party for $55. So basically, we're finally going to realize that gain. Actually, I'm going to be more formal about this. I'll say gain on sale of land. We're finally going to go ahead and recognize that gain because the earnings process has been completed. Again, we go to the income of the non-controlling interest, and they're going to get their share, 40%, of the subsidiary's adjusted income. Now, the subsidiary's adjusted or realized income, they've got the $100,000 they reported, plus this $10,000 that we took away back in 2018. We're now giving it back and saying, yeah, now you can recognize it because it's been realized. So the income to the non-controlling interest, $44,000.